Imagine this. It's 2 a.m., your phone won't stop ringing. A family emergency just hit, and you need $50,000 by morning. You have it. You're not broke. In fact, you have more than $50,000 sitting in your portfolio right now. But here's the nightmare nobody talks about. You can't touch it. Not tomorrow. Not next week. Maybe not even next year. And while you're sitting there, staring at numbers on a screen that look like wealth, you can't pay for the ambulance outside. That is the difference between liquid and illiquid assets. And it is the most dangerous thing the financial industry does not want to explain to you clearly. Because the moment you understand it, you'll start asking questions that make them very uncomfortable. So today we're going to do the math they hide. Stay until the end, because the last number I'm going to show you will completely change how you look at your portfolio. Let's start with the basics, but not the boring textbook version. A liquid asset is anything you can convert into cash fast, without losing significant value in the process. We're talking hours to days. Think cash in your checking account, stocks in a publicly traded company, ETFs, money market funds. You press a button, the money appears. Done. An illiquid asset is the opposite. It takes time, effort, sometimes years. And here's the part. Nobody emphasizes, you almost always take a discount to sell it fast. Real estate, private equity, hedge funds with lockup periods, artwork, cryptocurrency, during a crash when the exchange freezes withdrawals, business ownership, even certain bonds. Sounds simple enough, right? Here's where it gets dangerous. Most people think liquidity is just about convenience. They think, I'll keep some cash for emergencies and the rest I'll invest. And that logic sounds perfectly reasonable, until reality sends you a bill you weren't expecting. And reality always sends that bill. Job loss, medical crisis, divorce, a business partner who walks out, a market crash that wipes out your income stream overnight. The financial industry knows this. And yet, study after study shows that financial advisors consistently overweight illiquid assets in client portfolios. Why? Because illiquid products, private rights, annuities, hedge funds, structured notes might carry significantly higher commissions. Your advisor gets paid more when you're locked in. Let that sit with you for a second. Now let's talk about real math. Because this is where it gets uncomfortable. Say you have a $500,000 portfolio. Your advisor has put $350,000 of it into a liquid, investments in a private right, a fixed annuity, and some equity in a startup. On paper, you're worth $500,000, you feel wealthy. Then the emergency happens. You need $100,000 fast. Your liquid assets? $150,000. Okay, that covers it. Barely. But wait. You also have $8,000 in monthly expenses. And that emergency is going to last 6 months. That's another $48,000 you need just to survive while you sort everything out. $100,000 plus $48,000 equals $148,000, and you have $150,000 liquid. You are $2,000 away from having to liquidate an illiquid asset under pressure. And here's what that actually costs you. That private rate has a redemption queue. You'll wait 18 months minimum. The annuity, early surrender charge of 8%. On $100,000, that's $8,000 gone instantly, just for the privilege of accessing your own money. Startup equity? Completely illiquid. You can't sell it unless someone wants to buy it. Nobody does right now. You just discovered that $350,000 of your wealth is a mirage in a crisis. This is called the liquidity trap. And millions of people are sitting inside, one right now without knowing it. So what's the right ratio? What does the math actually say? There's a framework used by institutional investors, the people, managing billion-dollar endowments, called the Liquidity Ladder. And here's the simplified version you need. Tier 1, immediate liquidity. This is your 3 to 6 months of expenses in pure cash or cash equivalents. High-yield savings, money market. Nothing fancy. This is your survival fund. It should never be invested, ever. Tier 2, short-term liquidity. This is 10 to 20% of your investable assets and things. You can liquidate within 72 hours, without a major penalty. Publicly traded stocks, ETFs, short-term treasury bonds. This is your opportunity fund and your backup emergency fund combined. Tier 3, medium liquidity. Real estate you could sell within 90 days in a normal market. Bonds with reasonable maturity dates. Dividend-paying blue-chip stocks. These take time, but they're not traps. Tier 4, illiquid growth. Everything else. Private equity, startup investments, locked funds. This is where the highest returns often live. But it should never represent more than 30 to 40% of your total portfolio. If anyone is pushing you beyond that number, ask them directly, what's your commission on this product? Watch how they answer. Here's something else your advisor is unlikely to volunteer. Illiquid assets have what's called a liquidity premium, meaning they should pay you more because you're giving up access. If a liquid investment in the same risk category returns 7%, an illiquid one should return, at minimum 9 to 11%, to justify the trade-off. That gap, that 2 to 4%, is your payment for the inconvenience and the risk of being stuck. If your illiquid assets are not outperforming their liquid equivalents by that margin, you are taking on extra risk, extra restrictions, extra penalties, and getting paid nothing for it. Pull out your portfolio statement right now. Do that math. You might be very surprised by what you find. And now, the number I promised you. A 2023 study analyzed households that faced a financial crisis between 2010 and 2022, two groups, those with high liquidity ratios and those with low ones. Same average net worth, same income levels, everything equal, then except how accessible their money was. The high liquidity group recovered to their pre-crisis financial position in an average of 14 months. The low liquidity group, 7.3 years. Same wealth, same crisis. The only difference was liquidity, and it cost the second group nearly 6 years of their financial life. That is the real cost of illiquidity, not a percentage, not a fee, years. So here's your action plan. 1. Calculate your liquidity ratio today. Divide your liquid assets by your total assets. If it's below 30%, you need to have a serious conversation with yourself and possibly your advisor. 2. For every illiquid investment you hold, know the exit cost. Surrender charges, lockup periods, tax implications. Write them down. If you don't know these numbers, find them before your next financial decision. 3. Demand the liquidity premium. If an investment is illiquid, it must outperform. If it doesn't, walk away. Wealth isn't just about how much you have. It's about how much of it you can actually use when it matters most. Because the richest looking person in the room can be one emergency away from financial ruin. If everything they own is locked behind a door they can't open, don't be that person. If this opens your eyes, share it with someone who needs to hear it, because this is the conversation most people never get to have.